Hello, everyone. Welcome to the stock-specific class here for Thursday, July the 15th. Seeing a little bit of a market sell-off today, which really isn't surprising based off of the price action from yesterday. We'll take a look at that when we pull up the charts here. As far as the direction alerts, again, not much of a change. We have backed off a little bit of that extreme range on momentum. We're still in the trending area for breadth, and we backed off towards the far left side of the extreme range for sentiment. So from that standpoint, we're definitely not in an overbought market condition. With the selling that's taking place today, at least as of right now, I would view it as being just kind of a near-term pullback. I don't see anything major behind it. Now that can always change, especially if there's some sort of a headline that freaks the market out. But again, that's an unknown. We don't have that. We don't see that. So all we can recognize is just the condition that it's in right now, and it just looks like it's just kind of pulling back a little bit. There are going to be a couple of things I'm going to add to the market update that we can look at as well that could be early warning signals of something bigger to come. I've talked about these indicators before or these charts before, and I'll explain how they relate to. You got to make sure you're relating them to the right index. So, but we'll get to that here in just a second. I'm going to skip over because really there's not much. I just don't want to repeat Tuesday's market update going through the buy-sell ratios and sentiment and all that. Now let's go straight over to the charts. And the big signal yesterday that made it so that it was not surprising that the market pulled back today is we had a situation I often talk about where on 3 of the 4 indexes, we closed higher than where we opened, but still higher than the day before. So here's where we closed on Tuesday. This is Wednesday right here. We opened higher. We had that strong open, and then we faded into the close. We still closed higher than Tuesday, but still lower than where we opened. Now, when that happens, that's a bearish reversal. Doesn't mean that the market has to drop off of that. Doesn't mean that you're going to reverse into a downtrend. It's just a very weak price action. Or in the short term, in many, many cases, you're going to see an opening lower or move lower the next day, or at the very least within a day or two. Sometimes you'll try to rally the next day and then it'll fade the day after. Sometimes it shakes it off and goes higher, and that's a strong sign that that's a good bullish sign that it reversed it. If we would have just gone higher today and just completely reversed that bearish reversal, that would have been a bullish reversal, a bullish signal there. So it's important to be able to recognize that too, that hey, this thing had a bearish reversal signal, just shook it off and went higher today. This uptrend is pretty strong right now, and that's something to buy into. But from a probability standpoint, anytime you see that, anytime you see context is important. You got to be kind of running up into that price action. We've been running up. We've had 3 strong days right into here, and then we had that gap up. It closed lower than where it opened, but still higher than the day before. Not surprising that we pulled back today. Now, again, all that candle signal was for a very short-term move that we should pull back a little bit today. What does it mean going forward? Well, we've seen some of these one-day reversals. Here was a gap down, and then it went right back up again. It could be though that this is starting a little bit of a pullback. Like I said, I don't see anything major. Maybe it's something like back here where you have a few days where it pulls back and moves sideways a little bit. A little bit of congestion, but definitely it's the market showing a little bit of weakness here today, and But again, now if this would have happened and we were in those extreme, in the market, on the market or direction alerts, we were in those extreme ranges. If we had something like this that happened in those extreme ranges, I'd say, look out, we're getting started for something bigger here. You know, there's always a chance it could have one last gasp to try to move higher to suck more buyers in and then reverse. But you see that happen in an extreme overbought condition, and that you're getting ready for a bigger correction. You may not be able to time it perfectly, but you're real close, and you could take defensive action as far as getting out of trades. You could even take offensive action and buy puts or short stocks or what have you. Now, if we look at the other index as well, the Dow did the same thing. Now the Dow it opened lower, so it did drop lower off of that price action, but it's trying to rally back up, and maybe it does. I mean, we talked about how this is so close to breaking out that it might, we might see the Dow break out before we get a little bit of a bigger correction, and that's why I'm not saying that, hey, we're definitely dropping right here, but we're getting some of these early. Sometimes you'll get those signals, and it's just signaling early that that's a topping signal that the way the market's behaving is it's getting ready for a pullback, and it may be within a week or so that you start to see that. Maybe the Dow does make one more push to break out, where it clearly breaks out to a new all-time high. And then things kind of roll over from there. We've seen a lot of rotation happening within the indexes as well, where you'll see one index up for the day and one down, or a couple of them up, a couple of them down. They're moving in opposite directions. That's just money moving around within the system. And again, that's usually not very healthy. It's usually it usually means there aren't enough buyers to pull the whole market up, that money has to move into other areas to cause that buying, cause different sectors or segments to rally. And it's usually the professional traders that are doing that are just kind of moving things around, trying to generate a return because there aren't enough other buyers to push the whole market up. And then this gets back to what we talked about. We talked about breadth, market breadth. When there's that lack of market breadth, then there's chasing that starts to go on, and it becomes very difficult to know where that professional money is going the next day. It could be in healthcare one day and then suddenly into oil the next day, and not a real clear sign ahead of time that it was going to move into that. And then once you move into oil, it's out of oil into technology or something. And that's why when I talk about market conditions and difficult trading market conditions, that's a difficult trading market condition, because remember, as technical traders, like I often say, our job, we're not going to move the market. Our job is not to try to move the market. Our job is not to try to necessarily predict the market, because we can't. Our job is to follow what the professionals are doing. That's why we read the charts, and that's why we call ourselves technical traders, is we're trying to read the price action, try to figure out what those professional traders are doing. And in some cases, it's very obvious what they're doing, and it's very plain. It's pretty simple to see what they're doing, and it's easy to follow along. And the money that we're making is pretty easy, and we can get kind of lulled into a feeling like trading is a piece of cake. Other times, like I said, when you get into that area where there's that lack of market breadth, and the buying is kind of drying up a little bit, which typically happens near a market top, you can see these big professional traders just moving around. Like I said, they're moving around trying to generate the additional gains, and it becomes harder to read what they're doing. And so if you ever find yourself, the chart looks bullish, you get in. The next day it looks bearish, you get out. And 2 days later it looks bullish again, and you're into something else, and you feel like you're just losing money. And there might be little amounts that you're losing, but it just seems like it's nothing's kind of working out. That's usually kind of a sign that you're in one of those conditions. And there's two ways to deal with that. Either you really spend extra time, really try to focus and see if you can't see more subtle clues as to where those professionals are going. Or is what I often do is plan a vacation, get out of the market for a few days, take some time off, and avoid the aggravation, because like I said, in those types of conditions, you typically end up working twice as hard for half as much money. All right, so we'll see how that Dow chart kind of plays out. The Qs have been really strong lately, but they had the clearest bearish reversal. You can see here's where we've gone almost straight up through here. Opened up here on Wednesday, closed lower, but still higher than the day before. And again, that's misleading, because when you're looking at the, when the nightly news gives you the market update, they say, oh, it was a strong day today. The NASDAQ, the Dow, the S&P were all up today. It's not telling you the whole story. If you don't know how to read that price action, it was actually telling you the opposite. It wasn't a strong day internally, and not surprising we're down today. In fact, I had bought some puts on the Qs at the close yesterday, and I mean, I'm not up very big, but I try to take advantage of that price action, even if it only gives me a little bit of money. There's such a high probability of that drop. I try to take advantage of it whenever I see it. Now, again, I don't know. We just had one drop, so I don't know if this is going to lead to a bigger move down. Is this going to be a bigger correction? That's not telling me anything like that right now. We'll have to keep an eye on that. One thing that concerns me, though, is the Russell has been really underperforming. It's down again today. Look at that, how here's its all-time high up here, and it's gotten nowhere near that. It's way down here again. I often talk about how the small caps tend to be leadership stocks, and in measure they tend to kind of boost that market breadth. That shows you how healthy the trend is when those small cap stocks are participating. We're not seeing that, so that's definitely a warning sign. Now, again, these aren't immediate signals that mean that the market's going to drop immediately or anything like that, but they're ones that you kind of tuck away in the back of your mind. Hey, the Russell's really underperforming. Now, if it starts to really overperform and take off again, then that could tell you that, hey, maybe this market is going to continue to try to grind higher, and maybe it does have another run in it. Sometimes you can see a warning sign of a market top and an eventual pullback a month before it happens, and you might see a cluster of little clues. The market recovers from that. It's kind of like a boxing match, where a boxer gets hit in the ribs and he goes down, and you can tell he's hurt, but he gets back up and he starts fighting again, and you think that everything's back to normal, but that punch to the ribs, it caused some damage, and it was an early warning sign that other boxer just took an advantage, took the upper hand there, and that boxer may go down the next round because of that hit to the ribs, that breaking those ribs. So we try to look for those little subtle clues of, hey, has there been some damage to the trend? And definitely the Russell's been showing damage to the trend here for a little while. We'll see if that starts to play out in actual with the actual market dropping. Again, I go back to the fact, though, that we're not in an extreme overbought condition yet, and that would be easier to really say, man, this thing is getting real close. All right, so now I want to skip down to the VIX. The VIX is starting to move up a little bit today, but not anything. It's not spiking in any significant way. So again, they're selling today, but there's really not fear behind the selling, and so we don't want to. That's why we don't want to assume this is the start of something bigger just yet. It may not be, or it could transform into that. But I'm not seeing anything from the fear index here that there's too much concern yet. One thing, though, to keep an eye on, if we do have another day that drops and we do see the spike, as I've talked about how on this market rally, And we've had these little pullbacks in the market that have spiked the VIX a little bit, but they've all been lower highs. You can even go back into here. So if we happen to have a spike that takes out this lower high right here, that I think that's going to be significant. That's something to watch for. Obviously, we're not there yet, but I'm just trying to, I'm just trying to show you what talk through what I'm looking for, or what would be significant for me, and that you can kind of keep track of that yourself. Now, a couple of tickers I've added to the market update. Now, I don't much like the VIX. We look at the VIX each week in the market update because it is something that can be an important tool for us. But one thing I always tell you about the VIX is that it's not telling you something every day. You shouldn't assume that you're reading anything significant from the VIX every day. I think there's danger in that if you start to assume it's telling you something every day. Another indicator that can be very helpful in, and again, what we're looking for is divergence. But you also have to be careful what you're comparing it to. One is the semiconductor index. The SMH is the ticker symbol. We know that semiconductors basically run everything in technology, right? Everything that has a computer or uses a computer is using a chip. And there's lots of different chip companies. They all service these different technology companies. And so much like and I'm going to look at the Dow Transportation Index here in just a second, much like the transports can give us an idea of the health of the economy, are goods being transported around the country, is that picking up or is that declining? That could tell you how the economic activity is going. This can tell you how the technology stocks are doing, is how well the chip stocks are performing. And it tends to be a leading indicator. And again, it can be subtle, and you got to be careful not to draw absolute conclusions to it. It needs to be part of a number of things that you're analyzing. But what I like to compare the SMH to is the NASDAQ 100. That's I know there aren't all the stocks in the NASDAQ 100 aren't technology companies. Costco's in the NASDAQ 100. I wouldn't consider that necessarily a technology company, but the majority, it tends to be the majority of stocks within that index are technology stocks. When we tend to think of technologies as a sector, we tend to look at the NASDAQ 100 as an index that reflects that. And so what I see here is today we're seeing the chip stocks just get hammered. Big drop. We did have a deeper drop right here. It did try to rally, and yesterday it actually opened at a higher high, but then reversed it, ended up closing lower for the day there. And if we compare that to the NASDAQ 100, notice how it's been in a stronger uptrend. So it's been showing a lot more strength, whereas the chip stocks had already started to kind of roll over. Let me show you the other chart here. Let's pull up the SMH. You can see what I'm talking about. So you see this looks like it's clearly up. I know we see the last couple of days we're down a little bit, especially today we're down a little bit, but look at the difference. Look at what the SMH was doing prior to that. It had a deeper drop right here and then tried to recover. So it looks like it's starting to kind of roll over a little bit. Now, again, this is not suggesting that everything's going to fall apart immediately or that it can't recover from this and go higher, but these are little clues that we're seeing. We're seeing that weakness in the chip stocks, and we could start to see that move into weakness in some of those NASDAQ stocks, those technology stocks in particular. You can even look at longer term charts. You can see that, look at the chip stocks for the last 6 months. They've basically been in a range right here. whereas the QQQ has been, I mean, it was a little bit range bound right in here, but it took off. It took off right here. So it broke out, took off, and the chip stocks really didn't participate in that breakout. They broke out a little bit, and then immediately they're starting to kind of roll over. Okay. Now, much like, you know, you could use an analogy of getting sick. You know, sometimes you get sick and you're not feeling too well, and then you recover a couple of days later, and then you feel great and you're fine. Could it be that this is just the chips not feeling well, and then they do feel well, and they start leading the way, they start really taking off, and the NASDAQ 100 follows them or starts going along with them? Absolutely, that could happen. And that's why we're not market psychics or forecasters. If that's what I see, if I see it, but hey, the small caps have turned around, and the chip stocks are turning it around, and they're looking stronger again, and they're in fact they're performing better than the NASDAQ 100. I would expect that NASDAQ 100 would eventually start to follow that and move along with that. Another one, like I mentioned, is the Dow Transportation Index. You can use the ticker symbol IYT. IYT is the ETF for the transportation stocks. Now, it's very important. It's very important comparing apples to apples. Okay. When you look at the VIX, what do I always tell you? When you're looking at the VIX, what are you comparing the VIX to? You're comparing the VIX to the S&P 500, because the VIX is reflecting the changes in the index, the implied volatility of the index options of the S&P 500 index. Okay, I don't want to be comparing the VIX to the Dow or the VIX to the Russell 2000. That would be an apples to oranges comparison, and I'm going to run into trouble. So if you're using the VIX, you compare it to the SPY or the S&P 500. If you're looking at the chip stocks, the SMH, you want to be comparing that to the NASDAQ 100 or the NASDAQ composite if you want, but the NASDAQ index. If you're looking at the Dow transports, you want to be comparing it to the Dow industrials. Now, this goes back to what's called the Dow theory. I think I did a training on the Dow theory a while back, a few months back. You can probably search for that on YouTube and find it, but maybe I'll do it again sometime, but I don't want to get into it today. But basically, again, the idea here is that the transportation stocks, these are the stocks that are moving things around the world. They're your railroad stocks, the airline stocks, FedEx, UPS, they're trucking companies. And the idea is if those companies are performing well, obviously if they're making money and they're doing well, it means that they're moving a lot of products and that the economy is doing well. The transportation stocks tend to lead the way versus the industrial stocks, the Dow industrials. Okay. And the Dow industrials are usually reflective of the largest companies within the U.S., representing some of the different sectors out there. And a lot of times you'll see movement, same thing as what we were talking about with the chip stocks. The transportation stocks tend to be a leading indicator. Well, if we see the current chart of the Dow transports, we see that they've been trending down. Here's where they peaked right here back in May, and they've been just kind of declining, lower highs, lower lows since then. They're acting like a downtrend. How's the Dow look during this time? Well, Dow has been trying to break out here. It did have a new closing high right here. It hasn't gone above this intraday high from back here, but it's been trying to break out. Now remember, the transports tend to be the leading indicator. So how I would interpret this is that there's a divergence here, that the transports aren't confirming this breakout or this attempted breakout in the Dow. It's a warning sign. Now, again, could it be that suddenly we see the transports take off and they start taking off, and then you see the Dow break out along with it and go, yeah, that's possible. But as of right now, there's a divergence there. And you can see back here, look at the strength of the transports back here. This was going straight up right through here, February to May. And although the Dow industrials were also moving up, notice how they had bigger corrections along the way. They had these little pullbacks along the way. It wasn't moving as strong as the transportation stocks were. And I know this type of analysis, I get it. For some of you, this drives you nuts because it's not a mathematical equation, that says, X times Y equals Z or whatever that mathematical equation is. You want to, it's more of a, it's just kind of more of a feel, or more of a, it's very vague. But that's why I don't want to use this, and it's very important. I'm not saying we use this as a primary indicator, okay? And we're not using it as a primary indicator. It's like trying to diagnose an illness. You're seeing some symptoms here, and you're trying to determine, are those symptoms serious, or are they something that's not that big a deal? We'll get over it and move on, okay? And then we look at more of the specific things when we're looking at analyzing the individual charts. But it helps kind of give us an idea of the environment we're in. And so if you go back and listen to the last several updates, in the last several updates I've given, it's been, hey, we're in this period. It looks like it's a period of transition. We're not calling a top yet, but it's acting like we're at a top. This is what I'm talking about. These are the things I've been analyzing to kind of come to that conclusion. All right, let's take a look at some individual stocks here. I didn't mean to go that long on in fact, I might just see how time goes, because we might just call that the training for today, and we can get into the other stuff that I was going to get into that in the next update. All right, so let's take it. So again, the point of going through all this is now we're going to get into individual stocks. And as I say from time to time, that's why we do this update thing first, is to know what the environment is. Okay, obviously, from what I've talked about, we're not in an environment where we really want to be aggressive, where we want to be jumping into a whole ton of different stocks, getting into a lot of different stocks. Now, what's going to help us a little bit is that as I go through the scans, there's not a lot of stocks I really like. In fact, there's a lot of them, as many of you noted, that we've just kind of been repeating for a couple of updates, because there isn't anything really new that we want to jump into. Now, I'm not saying that we can't find other trades. I could drop down in that strength rank. I could go down into the 80s or the 70s and find a chart pattern I like. But why? Because the fact that I'm not seeing a lot of great trades right now in that 98 strength rank or in the 90 strength rank range for the most part, that's telling me that, again, this is not a great a great time to be aggressive. In fact, with some of the trades, even some of the stocks that we've been kind of putting on a list to watch, some of them kind of falling apart a little bit. I'll show you a couple of them that we've talked about lately that I would probably push off to the side. They never gave the confirmation buy signal, and that's the good news. But I'd probably move on from them from now. I'll go over a couple of those here in just a second. Let's go into the retail sector right here. I did like SIG here, Signet Jewelers Limited, 97 strength rank. Again, it's down a little bit today, or last couple days here, but what I'm looking at possibly here is that this is wave A, wave B, wave C of a correction. Let's switch this to signals here. So we've had a hold signal. Definitely would wait for it to go back to buy, and definitely wouldn't want this to drop too much further. If you want to draw, here's where the previous resistance was. Here's where it broke out. It's kind of pulled back to that area here. You'd want this area to hold. If it can't hold, if it starts to dip down into this area here, that's not a good sign. Another thing on these to keep an eye on as well, and it's something that I'm usually looking at. I don't always talk about it when I'm analyzing the stock, but because it's just something that it just is automatic for me. I don't always think to mention it, but you can go back and review these tradings on YouTube, but I talk about the stair step, that stocks will typically stair step in the uptrends. They'll stair step their way up, stair step their way down. Now, in these pullbacks, when I went over the Fibonacci retracements class, this is a few months ago, the concept of the retracement is that stocks will tend to retrace about 50% of their moves. The key word there is about 50%. Do not get caught up in exactness on this. But in fact, within that term about, we have a little bit of a range of from Fibonacci ratios, 382 kind of being a minimum retracement we expect, 50% being the main concept, or the general retracement, and then the 618 is kind of being the maximum, 61.8% is being a maximum. Now, why is that important? Well, if I have a stock that is just retraced a little bit, it's probably, if that is a correction it's in right now, it probably is going to go a little bit further to at least where it's at that 38.2%. And again, what we're retracing is this whole move up right here from the low down here to the high where it started to pull back from. If it's just a little retracement, it probably is going to go. It's probably not done yet. Probably is going to come down a little bit deeper. When it gets to that 382, it's kind of met that minimum retracement level. Stocks will tend to retrace about 50% of their moves, or about half the move that moved higher. So, and then the 618 down here, 61.8% is the lower end of that range. So you have what we call a retracement zone. Here's our zone. It's kind of like a strike zone in baseball. Here's where I expect the stock to pull back to. And I know it's real general, but it's going to be real general because stocks just don't move in an exact fashion. Once it gets to that 50% retracement area, then that's where I expect it to start to move back up. It doesn't mean it will, but if it's going to start to move back up, this is the area where it'll start to move back up. What happens if it dips below that 618? Well, that starts to reduce the probability that you're dealing with a pullback. You could be now dealing with a trend reversal. Because if you're stair stepping up, typically you'll pull back about 50%, pull back about 50%, pull back about 50%. If I start to pull back more than 50%, more than 61.8%, I haven't gone to a lower low yet here, right? I haven't taken out this low yet, but I've retraced so far that now the probability is, hey, you're probably in a trend reversal. this is probably an impulsive move up, and you're dealing with an impulsive move down, and you might be reversing that trend. Again, it's in recognizing that shift in probability. Well, we're at a pretty critical spot here on SIG because, here's that move up. If this is an ABC correction right here, you're sitting pretty close to that 50% retrace. In fact, we can use the retracement tool to see where that is. Yeah, we're right at the 50% retracement. It could dip down a little bit further here, down to about $67.20, and still would be within that retracement zone. But if I'm watching this for a few days, I'm expecting this to start to go back up here pretty soon. And not only do you have that 6 from 8 retracement zone down a little bit further, but you also have these previous highs right here, that breakout area. Now, if it dips below that, let me take the retracement zone off here. If it goes below that, it hasn't gone to a lower low yet here. This would be this is the last higher low right here. But your probabilities significantly change. Now you start to get into an area where, is it possible or is it probable? Yeah, everything's possible, okay? It's possible the Dow could jump 7,000 points tomorrow, right? Is it probable? No, it's not probable. It's never done that. So this is the tough thing, because as traders, we have to fight this all the time, because we're human and we want things to happen. We want to know what's going to happen next, and it's real easy to think of the possibilities over the probabilities. If you don't believe me, how many of you go to casinos? Or how many of you, even if you're not a steady gambler, if you're at a gas station in Nevada and there's a slot machine, you'll say, oh, let's just dump a few quarters in the slot machine. Why do you do that? You're definitely not doing it based on analyzing the probabilities, because the probabilities would say you're just going to lose your $5 or $10 that you're putting in that machine, or $100 or $200 if you're, or $1,000 or whatever, depending on how much gambling you're doing. If you're truly analyzing the probabilities, you'd be nowhere near a casino ever. Why do you go? Well, because you like the possibilities. The possibility that this quarter I'm putting in there is going to win me the car, and many of us justify it by, yeah, but it's entertainment. I'd spend that money at a movie or something, and so it's not. That's fine. You're getting entertainment value. You're getting some value out of it, but you're not analyzing the probabilities, because if you were, you'd be nowhere near a casino. The same thing can happen in the stock market, where it's real easy for us to focus on the possibilities. Remember what I talked about last class? I said, anytime you get into the trade, every time you buy a stock, it's because you believe that stock is going to go up in value. You will never buy a stock that you don't, on some level, for some reason, believe it's going to go up in value. Now, that reason for believing it could go up in value could be well thought out and analyzed. You've analyzed all the fundamental data. You've analyzed the chart data, and you've come to a conclusion you believe that stock's going to go up. But it could also be as ridiculous as overhearing on the airplane somebody talking about how XYZ stock is going to become the next Apple, and you just go buy the stock just because whoever that guy, you don't even know who he is. He could be insane, but because he thought that stock was going to go up, you believe it's going to go up. It could be as ridiculous as that, but whatever the reason is, you believe it's going to work out. So we have to fight this. We have to fight that balance between probabilities and possibilities. And these are ways that you can know you can have confidence in that you've crossed the line. As long as it stays within that retracement zone, it's still within the probabilities that it could continue to move up. Once it drops below that retracement zone and drops below this breakout area, now if I'm trying to hold on to stock, it's because I'm hoping it goes up, or it's possible it could still go up. I'm no longer thinking very rationally about it. Now, what would be a good signal to me that this drop is done? Well, one easy one is you could wait for it to go back to a buy signal. That's the simplest way to look for confirmation to get into something like this. But one basic one that you could look for that I like to use is a close above the high of the previous day. If we suddenly tomorrow had a move up and we closed above today's high, and the key there is close, not trade above, but close. That would be a strong bullish reversal price action. Close above the high of the previous day or a close below the low of the previous day, or they can signal continuation, strong continuation, or strong reversal. Notice how during this drop, let me just switch this to candles here for a second. Sorry, I'm kind of way off topic here, but I'm just going over some things that I think are good things to learn, and sometimes, sometimes I don't always think about things to teach people, but sometimes when you're just going through something and you can pass on some wisdom, I guess you could say, it's sometimes better to just go with it. So notice how during this drop, it kept, here it started to drop. It closed below the low of the previous day. That's a confirmation that you're moving lower. The next day, it closed below the low of the previous day. That's confirming that downtrend. Here, it didn't close below the low of the previous day, but it did close lower than the close of the previous day. That's still a continuation right there. Now here it closed below the low of the previous day, but also closed higher than where it opened. That's a little bit of a bullish reversal there, but sometimes those can get reversed as well. The next day, it closed above the high of the previous day. That's a good sign that this downward move could be done. Now, if that's true, I would expect to close above the high of the next day, and it didn't do that. It closed above the close of the previous day, but it didn't close above the high. And then what happened? A couple days later, really nothing happened these days. It didn't close above the high or the low. This next day, it closed below the low of the previous day. All right, that tells me that isn't a rally, and we're back to moving down again. Now, this happens a lot, by the way, in forming the ABC pattern. That's why that ABC pattern, that B wave of an ABC pattern is referred to as a sucker's rally. You think that's the pullback. You think this is the pullback. It looks like it's taken off again. This is the buy the dip. And no, that was the sucker's rally. It rolled over and it dropped again. So now it's moving down again. So what happens if we're down in this 50% retracement area, down at that breakout area, and then suddenly we close above the high of yesterday or today? Let's say tomorrow we close above today's high. Well, that could be a signal that the correction is done and that you're starting to take off. Now, you would need to see confirmation of that. You'd want to see, usually I want to see at least a close above each day's high to show that buyers are continuing to push things up. But a close above the high of the previous day is even stronger confirmation. And I'm not saying that just getting a close above the high of the previous day is an entry, is a signal to get in, but that could tell you that you might be on your way to getting that buy signal. Might be worth keeping it in your watch list. Okay. All right. So that's one to kind of keep an eye on. That was a long one to spend time on, but we learned some things on that one. All right, let's go to conglomerates. And let's look at the top one on the list here. 97 strength rank, LIVE. And again, this is based off of, again, having the strong uptrend right here. And this looks just like it's kind of moving in a consolidation range right here. You've had a couple touches up here. You've had several touches right through here, and then another touch right here as it started to move back up. Now, again, we're waiting for it to go back to a buy signal. That could be your confirmation. You could wait for it to break out of the range. A lot of times I like to, when I see a clear sideways range, I'll wait for a breakout of the range. It's just a little bit stronger confirmation for the trade. If it breaks below the range, you could walk away from it, move on to something else. But we'll see how that kind of develops there. And it could, and another reason why I like to often wait for the breakout is it could stay in this range for months. You could be, sitting on the thing, your money could just be sitting there doing nothing for 6 months as this thing consolidates. Because that back and forth movement is a reflection of indecision. The buyers don't know if it's strong enough to go higher, if they're committed enough to go higher. The sellers aren't committed enough to sell it on or to get out. And it just can get kind of move within these ranges for a little while. If it does break out, though, that tells you the buyers are willing to pay the higher price, and that can really jumpstart it. And then what's nice about that is then you could take the sideways range right there that it's been in. Usually if it breaks out, you can use the top of the range, the bottom of the range, project that distance upward, and that gives you a pretty good rule of thumb of how far that stock should move up at a minimum. Again, it's not absolute, it's not exact, but it does it enough to where technical traders will use that all the time, use that as a target point to at least give you an expectation of how far you think it could go. Let's go to the transportation sector here. And this HYRE, 97 strength rank. And went to a sell signal today. And the last 2 days have been pretty ugly here. But again, what I'm kind of looking at is we have this nice uptrend right here. Could this be kind of an ABC correction? Now, this is where I think your retracement zone can be important. I'm eyeballing it. It looks like it's at about a 50% retracement of this move up. We could look at it more exactly with the Fibonacci tool. Yeah, we're right at that, just a little bit below that 50% retracement. 618 retracement is just down here a little bit lower. So this is at a spot where if it's going to start to reverse and go back up, this is where it should reverse and go back up. It gets down below, $14.70. It'll be below that 618 retracement, and you probably want to, the probabilities would start to dramatically shift at that point. It may be that you're in a downtrend that you get another day where it drops down into here like this, and that looks like a trend reversal. That's no longer looking like a pullback within the uptrend. So this one has some work, and it may be one that we just move on from within a day or so if it drops down too much further there. But that's one I thought that you could kind of, if it does reverse and go back up, that could be, it could be starting a new impulsive move up. All right, computer and technology. ZDGE, we've gone over this one before. ZDGE, kind of similar to what we're looking at with, I think it was Live, LIVE, but just kind of a sideways range. And let's move up. Here's kind of a consolidation. Now, again, this could stay sideways. It's been moving sideways for a month now. It could keep doing that. So this is one where I'd probably wait for a breakout, maybe up to, up above 19. And then you could take the distance of the range, project that upward, and give you kind of a price target of expectation of how far that thing could go. We had to move down today. We're getting down to the lower part of this range. That sideways range lines up with this resistance area here. So if we break down below that, that's probably not a good sign. Even though, technically we'd still be at a 50% retracement of that move up right here. It could dip down to this area right here and still would be within that retracement area. And actually there's some resistance here, and maybe that's still possible. Maybe it could still dip down to there and move higher. I don't know that I'd be wanting to wait around that long though. I'm sure we'll come back to this one again. I told you some of the stocks we've looked at recently that I no longer think are good candidates. DDD is one of them. We went over this one a week or so ago. What I liked at the time was, here's you'd been declining, now it looked like you're moving up. You had this little pullback right here. You went to it, so you had the higher high, you had the higher low. So it was acting like an uptrend, and then it pulled back right into here, which is right at this breakout area right here. It's right at probably the 618 retracement of this move up right here. This is the critical area. I think I mentioned that. That's kind of the critical area right there. And then moved below it, and now it's on the verge of going to a lower low right here. Because now what could be going on here is that this rally was just, here's the decline. This rally might have been a bearish ABC pattern or a correction of this decline. Retraced 50% of that move down, and then now it's going to have an impulsive move down. I don't know, but I just know I don't like the way it looks right now. I don't see anything that's any probability that's in my favor right here for the stock to go up. Is it possible it goes up? Yeah, it's always possible, but I don't like the probabilities here. And that probability shift took place really on that move down right there. That's what changed everything. Now, it never went back to the buy signal, which was the confirmation, the easy confirmation we normally talk about. So, we from that standpoint, we would have never been getting into it anyway. But this is one I'll just move on from. Who knows? Down the road, we'll come back to it, but I'm not looking at it right now. And same with HIMX. This is another one in the computer and technology that we talked about on Tuesday. We were looking at higher highs, higher lows. It was going to that buy signal right here. This is probably, as deep as this is gone, this is probably going to go below this low. We're probably going to go to a lower low. And because we come back down this low, it looks like a kind of more like a bearish head and shoulders pattern now. Now, it didn't quite look like that on Tuesday, because it looked like it was still possibly working its way higher there through there, but as it rolled over now, it kind of looks more like a head and shoulders pattern. So I'm kind of backed off of this one. Now, we did this one with the risk management. We did this as one of the risk management trades. I think I put my stop below this low right here to give it a little bit more room. and it may not. It may not end up stopping out. Maybe it dips below the slow and then reverses back up. But that was what I was willing to risk on the trade, so I'm going to stick to that. But it's a good example of how we control what we can control. We can control our position size. We control our stop loss, but we can't control the outcome, what actually ends up taking place. Let's do a few more here. Let's look at this GSAT, Global Star. Yeah, this one's right at a spot that's kind of critical. So we do have higher highs, higher lows here. But we're right at that. This has got to be right at that 618. Let me use the Fibonacci tool here just to double check it. But I don't always use the Fibonacci tool because just over the years I can almost eyeball it. It just saves me the time. But yeah, so we're right at that 618. So it's critical. Now you could be a little bit below it. We don't want to get, we don't want to be so focused on exactness. Stocks don't always go to exactly these levels in reverse or whatever, but we're definitely in an area here where it needs to start to move back up immediately, or the probabilities will significantly. We have another down day, and the probability of this thing going up will diminish quite a bit. But keep an eye on it, because if it does close above today's high tomorrow, notice how during this drop it hadn't closed above the high of the previous day. It could be a sign that it's starting to go again, and it starts to take off from there. A couple ones on Tuesday that we mentioned that I said were really close in the critical area. Mara was one of them. Riot was the other. These were business services sector. Well, Mara, remember, it had to hold that low right there. Well, it dropped below that. It's gone to a sell signal. This thing is probably heading lower. So that was off the radar. It didn't hold, but we never got the confirmation anyway. But I probably won't bring these ones up for a while again too. They both kind of, because now you've changed the trend direction. You had the higher highs, higher lows. Now you've gone to a lower low. It's acting more like a downtrend right now. All right. Hopefully that was helpful. What I was going to talk about today, but I'll do it next week on Tuesday's market update. I want to spend a little bit more time on some trade management techniques. There's so many of them, but as we were going through the risk management, and we were talking about position sizing, and a lot of that was based on stop losses, I just had the idea of maybe going through some additional stop loss techniques you could consider. Because I don't have one stop loss technique that I use. I go by a philosophy, and the philosophy is I want to stop out of the trade at a point where I know I'm wrong, and that point where I know I'm wrong can be different in different situations. And so I'm going to go over some different techniques. I've already kind of gone through some of them, but I'll try to put together one little bit more organized training there to give you just some ideas that you can use and just incorporate into your trading. All right, thanks everyone. Have a great weekend, and we'll see you next Tuesday for the next market update. Bye now.